Good afternoon. Market news now. China's stock market led Asian gains while Japan climbed on confirmation of a stimulus package. Hong Kong struggled as Alibaba Group sank on a slashed revenue outlook, contributing to a drop in the gorge for Chinese technology shares. Looking at what's happening globally, global stocks continue to hover near records, propped up by robust U.S. corporate earnings growth. But price pressures that could accelerate interest rate hikes and hamper the pandemic recovery are shadowing the market. To give us some more perspective, we are joined by Warwick Lucas from Galileo Securities. Warwick, thank you so much for your time. Yesterday, we had the MPC decision coming out to increase the repo rate by 25 basis points to 3.75%. How has the market and our currency, digested the news?
I would say that our market, Tash, is digesting it with a certain degree of aplomb. I think we are very much in the situation where we are following other emerging markets with a small hike, just to remind investors out there that, in fact, this country does still take inflation seriously. Of course, our economy is not in a particularly strong place, so I think we're in a situation where any future hikes probably don't have to be as steep as they might necessarily be in economies that are firing harder and don't have the likes of power problems and the aggravated unemployment that South Africa does. But I think it probably put a little bit of a marker in the ground just to say that this is the point in the cycle where interest rates quite definitively start tracking a little bit higher.
On taking inflation seriously, is there concerns that, the Fed could be behind the curve? Does it even have enough time to wait for the U.S. labor market to heal and go back to pre-COVID levels?
I think that the Fed was always quite clear that they would allow inflation to run ahead of the cycle, and certainly under those circumstances, there is a danger that the rate cycle, or more particularly inflation, could get away from them. It was always going to be a bit of a tricky break and clutch situation. I think one potential surprise factor out there for the Fed could be what the energy markets do. We've seen coal prices and oil prices look pretty firm. I do see that dollar looking quite strong, though. I think that explains some of the rand weakness that we've seen recently. Certainly that dollar strength suggesting to me that markets are anticipating that the Fed is certainly on a hiking footing, which, of course, they have already indicated with the tapering operations.
On that note, then, what do you think will be the trigger for a more hawkish framework from the Fed?
I think the sign would be something like a more sustained inflation outlook. So not something like an energy input or food price hikes or anything like that, but something that suggests, hey, inflation is actually looking like it's going to start sticking around a bit longer. Certainly, the steady improvement in unemployment in the U.S. is shall we say, proof of operational success to the Fed. And of course, the Fed's mandate does include dealing with unemployment. So I think whether we would see returns to previous very low unemployment rates of below 3% before they start hiking, I'm not sure we'd necessarily see that. But remember that the Fed has always indicated a bit of an appetite and a capacity there for inflation this cycle around.
Right. So locally, we had Tiger Brands releasing their numbers showing that group revenue rose, but the civil unrest and, of course, the product recall seemed to have weighed on profits. What did you make of their financials?
Yeah, so I think that obviously the civil unrest is very disruptive for a lot of fast-moving consumer goods businesses, and it obviously affected them quite unequally. I think clearly for Tiger Brands there would have been a big disappointment. I think, though, that investors should remember that, of course, in the COVID year, Tiger's was always going to perform quite well, even in a kind of in a lockdown situation. I mean, there'd still be demand for their products. It'd still be ongoing earnings and so on from a food business. And so the base is really much higher than it will be for the other companies that you're going to see coming out with much higher earnings off the COVID year. So do bear that in mind in the case of a food business like Tiger Brands, and for that matter, perhaps AVI.
So we also have Moody's and S&P scheduled to give reviews on South Africa's credit rating. Are you expecting any fireworks, or do you think that it might be an event to look out for probably next year?
I think at this stage we'd probably be looking at a holding action, but very clearly we are under a microscope. I mean, elections were quite untidy. With a bit of ground shifting. Obviously, we need to see municipal governments starting to come together, and we need to see some very clear commitments from government, firstly on meeting the targets or primary projects set by Minister Mboweni during his tenure, and we're obviously going to have to see in particular progress or signs of positive forecasts coming out of Eskom before we can start saying that we'll see the rating agents guide us out of the woods, as it were.
All right, Warwick, thank you so much for your time. That is Warwick Lucas, who's the head of Galileo Securities. We're going to take a quick break. We'll come back. We'll have SME on point and, of course, your money.